Good morning and welcome, ladies and gentlemen, to our Perspectives podcast in July 2024, like always with Guy Wagner. Good morning, Guy.
Good morning.
From a macroeconomic point of view, global economic growth continues at a moderate level. The onset of recession has so far been avoided. Could anything reverse this trend, in your opinion?
I think what's important for the financial market is obviously the US economy, and what has helped the US economy over the last few months or even years was basically essentially two factors. It was, as always, private consumption, which is very important for the US economy, and private consumption has benefited from this idea of excess savings that people have accumulated during the lockdowns and upon which they have been able to draw over the past few 1 or 2 years to continue to spend. And the other thing is public spending, which obviously is also very high. So it's basically in that direction that one has to look when one wonders about a potential US recession. And I think one amongst these two factors is essentially the private consumption, because the latest numbers have shown that the excess savings have now disappeared. The savings rate is very low. So it will be interesting to see whether US households can continue to spend and increase in their spending. I think that's the main question mark right now when it comes to the US economy.
The Federal Reserve decided to maintain its key interest rates unchanged in the second quarter. However, a future cut could be possible at the second half of the year. What would that mean for the economy and the job market?
I don't necessarily think that a cut by the Federal Reserve will change the economic picture a lot. In the sense that, as I said before, I mean, private consumption, there are other factors that were behind the strength of private consumption. And I don't think that a cut or even a few cuts by the Federal Reserve will fundamentally change that picture.
The Eurozone presents a mixed economic outlook. What's behind this, and how can the ECB stimulate growth?
Yeah, I would say one thing is as a distinction between services and the manufacturing sector. Manufacturing sector is weak, also because global growth is relatively weak. Services have held up quite well, but it's also true that the stimulation coming from public spending was much less in the Eurozone than in the US, so that is one of the reasons explaining why the US economy is doing better. And again, I don't think that here too a cut of the European central banks will fundamentally change the picture. For the manufacturing sector to improve, obviously growth worldwide has to improve, etc. So these are other things than simply a cut by the European Central Bank.
Meanwhile, on the financial markets, the appetite for technology stocks remains strong, offering opportunities for active management. How would you describe this market at this time?
Yeah, it's a little bit a strange market in the sense that you have, on the one hand side, you have the rise, especially in these big technology names, and given that the market capitalizations of these companies have become so big, they obviously helping the markets to reach new all-time highs, because a lot of these indices are based on market capitalization. So the stocks which have the highest market capitalizations, the technology stocks, will drive the performance of these markets. But behind that, and you see a lot of stocks which have already had quite substantial corrections, but nobody's really interested in these names because, again, it's all about, or nearly all is about artificial intelligence, technology, etc. So it's a market, to a certain degree, a strange market, because behind the strength of the indices hides, or the strength of the indices hides quite a lot of weakness behind these indices.
With the dissolution of the National Assembly in France and the upward revision of the US budget deficit, the question of fiscal sustainability is more relevant than ever. How might we expect investors to react about that?
Yeah, I think the logical reaction for rational investors is to become more skeptical about government bonds from the big G7 countries, and then to ask for a higher risk premium to continue to hold these these assets. So that would mean higher long-term interest rates, which obviously then would become a problem for governments, because that would increase the cost of servicing the debt, and that's not something that necessarily the authorities want to see.
Let's move to China. China's market hasn't fully rebounded to its 2021 peak. What is expected? How does the risk premium describe investor sentiment right now?
Yeah, I would say that the Chinese market has suffered from a lot of things over the past 2 or 3 years. The first one was the decision of the party to regulate some industries a lot more, which has weighed on the confidence of especially foreign investors. Then you have the weakness of the property market in China, which weighs on the confidence of the domestic investors. And then you have the geopolitical tensions. So you had a lot of negative factors for the Chinese market, and so a lot of especially foreign investors have left that market, and by definition, the market is much lower than it was even 2 or 3 years ago, and today offers quite an attractive risk premium for those who are still willing to invest in China.
Japan's market is currently outperforming the US and the EU. What structural factors are driving this good performance?
I would say the main driver is better corporate governance. It's this idea that Japanese companies are increasing the return on the capital they employ, and that's obviously very important for the stock market. So, and they also have started to treat their shareholders better by buying back their shares, by increasing their dividends, etc. So from that point of view, it's really, and all these things are only in the beginning. So from that point of view, I think this is a factor which will continue to positively influence that market for the years to come. The other thing is also that Japan has been for years or even maybe decades in a deflationary environment that seems to be over. There's a little bit more inflation now in Japan, which also obviously helps the sales of the Japanese companies.
Mm. Let's talk about the bond markets. In a context of falling interest rates, do bonds still offer attractive opportunities for investors?
I would say if you, especially in the industrialized countries, if you start with the idea that government bonds, as we've said before, are not very attractive, and given that everything is priced off the government bonds, whether it's corporate bonds, whether etc., then basically the whole bond market especially in the Western world doesn't seem very attractive. You can always find a niche, like for example inflation-indexed bonds, which might offer or might be a little bit more attractive, but fundamentally it's not it has become quite an unattractive asset class.
Mm. To conclude, and like always, we should end with the price of gold, which is still rising, driven by geopolitical factors. Will it continue to appeal strongly to investors? For what reasons?
Yeah, I think that gold is still in a long-term bull market. There are two main factors. One is more geopolitical. It's this fragmentation of the world economy with, on the one hand side, the US and its allies, on the other, China and its allies, and with this willingness of China to put up an alternative to this financial system based on the dollar that we've known since the Second World War. And this is alternative financial system. Gold plays an important role, which also explains why the purchases by the central banks of the East are so important and have been essentially behind the rise in the gold price. The other reason is more financial. It's this idea that we've talked before about the viability of public finance in the West. It's this increase in the supply of euros and dollars that central banks can create out of thin air, whereas the supply of gold is obviously limited by production, and also gold doesn't offer a counterparty risk. And I think these are things that will continue also to make gold very attractive vis-a-vis paper money. And so I think that the gold bull market will continue, but obviously you can always have a correction. The gold price has gone up quite a bit in the past 18 months. So there's always this possibility that there will be some profit taking. You can never exclude a correction like that.
Guy Wagner, thank you very much for your insights.
Thank you.
To find out more, consult the latest edition of Perspectives 180, available on Banque de Luxembourg's website. Till next time, and take care. Thank you.